Hello and welcome to marketing91.com. Inflation is a scenario characterized by continuous and rapid rise in prices. This decreases the value of money or its purchasing power over a period. Characteristics of inflation are constant rise in prices, disequilibrium in economy, rising trend in general price levels, self-generating and feeds upon itself. Inflationary price rise is sustained and irreversible, influenced by interacting forces in an economy and caused by excess demand relative to supply of goods and services. The percentage rate of inflation is calculated as follows. R into I equals delta P of F divided by P of 1 minus F multiplied by 100, where R into I is the rate of inflation, F and 1 minus F are the observation periods, P is the price level, and delta refers to changes observed. For instance, in the table below, price indices reflect inflation trends in India from 1950 to 2011. Inflation is caused mainly by increased demand and increased production cost. Accordingly, the two important types of inflation are demand pull inflation and cost push inflation. Moving on to demand pull inflation. If demand has a greater impact on increasing prices, the situation is termed as demand pull inflation. An increase in demand may occur due to an increase in the income of consumers. It may also be the result of monetary and fiscal measures taken by the government, such as welfare measures, increase in government expenditure, reduction in taxes, and other measures which increase the disposable income of the people. For example, after a restaurant gets a rave review, greater demand will allow the restaurant to increase its prices. Demand pull inflation can be diagrammatically explained as follows. SS1 is the supply curve. OP1 is the price determined by the interaction of the demand curve D1 and the supply curve SS1. The demand curve shifts from D1 to D2 up to D5, and accordingly the price level increases from P1 to P2, P3 up to P5. The supply responds to an increase in demand up to point C, where the economy reaches its full employment level, or YF. Thereafter, the supply curve becomes vertical, indicating perfectly inelastic supply due to full employment. Now let's look at an example of demand pull inflation to understand it better. In June 2016, the government broadly accepted the recommendations of the 7th Central Pay Commission to roll out large salaries and pension hikes to employees and retirees. 47 lakh central government employees and 53 lakh pensioners benefited from this. Due to this, demand is set to get a big boost. However, it may fuel inflationary pressures and threaten fiscal discipline. Factors responsible for demand pull inflation include increase in money supply, size of population, credit creation, black money, export trade, and public debt. The next type is cost push inflation. If supply forces or cost forces push up the price level, the situation is known as cost push inflation. Increase in the prices of inputs such as labor, increased profit margins of business firms, and monopsony in the factor market may push up prices because the seller is in a position to influence the supply price. Supply shocks may also affect the cost of supply because the same or even a reduced quantity of goods and services may be supplied at a higher price owing to increased costs. For example, an increase in the price of oil increases the cost of production for almost all goods and services and results in an inflationary environment. Such inflation is cost push inflation. Similarly, events such as labor strikes, wars, and floods tend to reduce supply and increase prices. Cost push inflation can be diagrammatically explained as follows. OP1 is the initial price determined by the interaction of demand D1 and supply S1 at point A, which is full employment output YF. The supply curve shifts upwards to the left because of the increase in cost. The new supply curve S2 intersects the demand curve at point B, establishing a new but higher price P2. As the supply curve shifts further, the price increases and output declines. This increase in price is solely because of cost push factors. Factors responsible for cost-push inflation include higher wages, material costs, profit margin, natural calamities, and other factors. Inflationary gap refers to the difference between the aggregate money demanded for consumer goods and services and their supply. It can be explained diagrammatically as follows. YF is the full employment income. The 45-degree line is the line where income, or Y, is equal to expenditure, E. Point A is the equilibrium point at full employment income, YF. If the total expenditure C plus I plus G increases to E1 shown on the C1 plus I1 plus G1 line, there is excess demand equivalent to AE1 against the available output or real income YFA. The new expenditure line C1 I1 plus G1 intersects the income line OG at E2, resulting in money income OY1. The total expenditure is now Y1E2 against the available output YFA. This excess demand creates an inflationary gap denoted by the distance AE1 equals to BE2. Effects of inflation are on production, decrease in value of money, decrease in foreign investment, decrease in domestic investment, business uncertainties, diversion of productive resources, hoarding of essential goods, and loss of confidence. Effect on distribution are debtors and creditors, wages and salary earners, fixed income groups, entrepreneurs, investors and farmers. Effects on socio-political stability are class conflict and political instability. Inflation should be controlled in its initial stages to avoid hyperinflation. Measures to control inflation include money measures, fiscal measures, and miscellaneous measures. Starting with monetary measures, bank rate is the rate at which the central bank lends to commercial banks. In an inflationary period, the central bank increases the bank rate. Next is sale of government securities. The central bank sells government securities to the public through the open market to limit purchasing power and control money supply of households and businesses. The cash reserve ratio, or CRR, is the ratio of the cash held by a bank with the central bank to the bank's total deposit liability. An increase in CRR implies lower availability of credit through the banking system, which constrains purchasing power. Fiscal measures include cutting government expenditure, cutting taxation, public borrowing by issuing bonds, debt management to reduce money supply, and overvaluation. Miscellaneous measures are output expansion, wage reduction, and price control and rationing. Moving on, in contrast to inflation, deflation occurs owing to continuous fall in general price levels. By definition, it is a state of falling prices that occurs when goods and services output increases at a faster rate than the volume of money income in the economy. Usually, deflation results in continuous drop in general price levels, increase in the value of money, increase in unemployment, decrease in effective demand, and adverse economic effects. Stagflation refers to a scenario of high inflation along with high unemployment. The term stagflation was coined in 1973 in developed countries after rapid rise in oil prices led to drastic increases in the prices of manufactured goods and real GNP declined while the unemployment rate rose. In the graph, price level is represented on the y-axis and real output is represented on the x-axis. AD and AS denote, respectively, the aggregate demand curve and the aggregate supply curve. Here, the economy is in equilibrium at point E, where output is OQ at price level OP. A rise in oil prices results in a rise in production costs, causing AS to shift to AS1 and creation of the equilibrium point E1, which indicates rise in output to OQ1 and fall in price level to OP1. Such a fall results from increasing unemployment accompanied by price rise. According to Chetan Ahya, co-head of Global Economics Morgan Stanley, The root cause of India's stagflation environment in 2015 was a sharp deterioration in productivity as a result of the policy mistake of focusing on redistribution to households, along with a major dip in productive investment. Especially four policy outcomes fostered a toxic mix of high inflation and low growth: sustained rise in fiscal deficit, high growth in rural wages, negative real rate environment, and corruption scandals leading to stalling of investment approval, causing decline in investment. Thank you.